We are going to get into the third module, rather I should say third unit of the first block, risk and return. I've already told during when I was discussing the first thing or the second, the market. Market is a very volatile place. What do you mean by volatile? Is that it can go up, it can go come down. So when you look at it from the investment perspective, there are various things which can go in your favor, which may not go in your favor. So something we call risk, and of course we all look forward to return. And when you are in investment market, you know that there are some amount of risk. I hope I'm correct. So let's go to the next slide. Now, what is risk? I've collected something for you. In Cambridge Dictionary, risk means the possibility of something bad happening. Well, what's that? You think something will happen good, Tata Steel should go up, but it doesn't happen. So you lose money, or it doesn't happen, you don't earn as much as you thought. Interestingly, in Chinese, the word for risk is feng jia. It's written, as you can see it in the screen. It means there are two parts. First part means potential loss, and second part means opportunity. Some of the finance professor globally, they like this Chinese definition of word because of the potential loss and opportunity. And risk, from the investment perspective, it exactly that. We know there are risks exist, but we also expect a return adequate for the risk I am taking. So I also find, I'm also same school, that the Chinese definition directly says that there can be a potential loss, but there is an opportunity to earn more. And that is the risk you take, potential loss, but there is an opportunity. If the loss does not happen, you make money. You may not make money as much you thought initially, but also in spite of that, you will make some money which is adequate for the risk you have taken. And sometimes you make more money or little less money than the risk you have taken. Now let us try to understand risk and return from investment perspective in a better way. Now the term risk in investment has a different meaning in the sense it only refers to, in our normal parlance, many people will say don't take risk, don't get into the stock market, invest in the bank, etc., etc. Invest in the mutual fund, as if they don't invest in equity market or something like that. So there is a negative connotation, negative thinking about risk. But if you look beyond it, I will put it in the Hindi. Risk ke aage, yes. So that is like that. It also implies that chance of positive return. Risk ki aage jeet hai. So if you take risk, understanding how much risk you are taking, there may be a reward for you. So risk captures variation in expected return. So if you take a risk, you think that you will be getting a great reward, but the great reward may not be that much, but nevertheless it is a reward, not loss. So investment decision, so that is why I like to say that risk captures variation in expected return. So you purchased ITC at 400 and you thought it will go to 500, but it goes to 460. So it does not meet your expectations because you've taken risk, but then you get 60, or it may be 430. Worst come to worst, it can be going below 400, but then that means your risk calculation was something, you were overestimating, you were a little bit of speculating. Please relate my earlier slides with my present slides in the future also. So investment decisions are made based on expected future outcome. So you expect that this will give me this return if it is equity, and then I let me invest it. Broadly, we can classify our understanding and knowledge of future about the risk and return. I mean return about in the future into four categories. First is knowledge. It's called Kipu. Knowledge, ignorance, possible outcome, uncertainty. So it is knowledge, ignorance, possible outcome, uncertainty. Kipu. So let's erase it. So Kipu. Now, knowledge is at one extreme, we have certain knowledge. Like, suppose you purchased a Government of India bond, which gives 7% interest and will be redeemed at the end of 2030. You are certain that Government of India will not fail, they will give the required return, and at the end they will return you the principal. So this is called your absolute knowledge. But there are sometimes government bonds also default in the paying interest or delay, particularly state government bonds, another thing. So this knowledge is also, I can't say absolute. There's nothing absolute in this world. Ignorance. At the other extreme, we have no idea on the future. At the other extreme, we have no idea of the future. So what happens is this: we do not know what will happen in the future. So you invest in Reliance Industries. It's a good company. It has a large plan, Reliance Jio, Reliance Retail. But you really do not know how much the shares will go up, or with the online shopping, will JioMart compete, and with other things, whether things will be going all right or not. Excuse me. Right. Sorry. Just a minute. So now, uncertainty. The possible outcome. The third one is a situation where we know the possible outcome of its range. So we know that we are investing in this company and its share price can go, if it's very good, it can go this. If it is X, if it is not so good, it can go to Y. Uncertainty is we do not know anything beyond a certain point, that is like possible outcome. This possible outcome is not a certain point, but it's a range. But we have an uncertainty whether this range will be, the share price will be in this range or not. Then in that situation, there is an uncertainty, which is synonymous with riskiness. So we start with the knowledge and enter into uncertainty with a riskiness or uncertainty. I'll give you an example. Suppose Amit buys 100 ITC shares of 400 each, expecting after 1 year the price will be rupees 475. And considering that way ITC has paid dividend, he is expecting that dividend will be 15 rupees per share. If so, he is certain that he is going to get. He is certain that he is going to get. He is going to get 75. He is going to get this 70. He is going to get 75. He is going to get 75, and he is going to get 75, which is the capital appreciation, and he is going to get 15, which is dividend. That means 90 rupees will get on 400, which is 22.50%. So he is certain. Now, if he is certain, he will get this return. But how certain is his certainty? Will ITC go 475? It may go up to 425. Nirmala Sitharaman, madam, our finance minister may declare something against tobacco, another thing, and then the sales comes down. So the share price falls. It can be 425 or something like that, 450, or for some reason cigarette or other sales come down. So the dividend they reduce to 10 or something like that. So the whole return here is no more is 75. Suppose the price goes up to 460, then it will be 60 and dividend is 10, that means it's 70. So his expected return comes down. So he really does not know. There is a probabilistic estimate for him that it will go up, and then there is a chances that it will come down also. So there is a range. If we go more scientific, we'll go some range, and so that is what we are going to study. That how certain is a certainty. So there is a risk, and our understanding of the risk has Kipu factor, that something we are certain about, something we are ignorant in the sense future. But we can make a reasonable guess कि आज बारिश होगा या नहीं होगा, or like something like that. But uncertainty is that beyond a certain point, we are not very certain about what we think will happen in future. So that brings in some thing called uncertainty, which is synonymous in English with risky. So this is our understanding of future outcome and the riskiness of that future outcome. I hope you can understand now, and you can think in your life also, in some shares, in even if it is otherwise, that you go somewhere, you expect them to meet somebody's house, but you don't get him in there, but they offer you the hospitality. That's a little reward you get, but you could not meet the person you went to meet. So that is the riskiness, whether you'll be meeting him or not. So let's go to the next slide. I hope I have made it clear about the risk and the return, which always comes when you take a risk. But the problem is that the return, what we expect, that may happen, it may not happen, it may happen more than that, it may happen less than that. And in the extreme scenario, it cannot happen when you make a loss. So generally, as I told you in early years, speculators, I'll not touch the gamblers, they are not welcome into the stock market, but they are there gambling. But the speculators who really do some amount of study and for the short run and expect the share price go up, many times they see no, it doesn't go up, it has gone down, and they move out of that share and they move to another share where they hope the price will go up. And out of the 3 or 4 movements, in some places they make money, in some places they are making loss, but overall if they make money, they are in the market. And their movement keeps the market also volatile. And in this volatile market, you can enter at a lower price and you can get out at a higher price. And if you're disciplined, you have patience, you can make money. And that is our target, and you can reduce your risk also. Let's go to the next slide. Now, as I told you in the earlier slide, that the certain point is we are not very sure. The certain point we are not very sure, and I'm sorry, this. Certain point I am not very sure, but then this ITC share 400, 475, it can be 460, 435, 425. This uncertainty we always have. So there is always a probability of or chance of we are having 475 or not. So now let's go to this occurring of chances. Now that's called probability of occurrence. Since future is uncertain, you may have to examine probability of several other possible returns. So suppose you are friends and somebody says the ITC will go up, ITC will go up, or I will get a return of 10%, somebody says 20%. Suppose you are five opinion makers, or you yourself calculate, thinking of the not so good scenario, okay scenario, good scenario, very good scenario, and excellent scenario. But then there is chances of each scenario coming up. So you have a probability of occurrence. So if we say in this mathematical table, which is called probability distribution, 10% is chance that, sorry, that is 10% again, chance that I will get 10% return. 20% chance I get 20% return. But here I am maximum. 40% chance इतना तो मिलेगा ही. 40 to 22.5 तो I get it. Some 20% people can be very bullish. No, this year is good. These duties have cut, and another thing, people have money extra, they will smoke more, or they will buy more sunfish biscuits and other things, etc. So 30. 35, well, it is too much bullish. I think you are expecting too much. So there is various possible return. From one is the very conservative to one is very optimistic. And if we add all these things, it is 100. That means all the type of probabilities, 100% we have covered. The table above is known as probability distribution, and you can use it to have an insight into the riskiness of your proposal to buy 100 shares. So if you do, now we are coming to the very first slide, a little bit of analysis and looking at the history of the company and what is going on now, you can make a reasonable guess in the depending on the economy and other factors. There is a US tariff and etc. There is a less buying power in the people's hand, and in some pockets there is a good buying power because somebody is getting job and etc. etc. So you can have a very pessimistic return 10%. So you'll attach less chances of having that. On the middle, 22.5% is a decent return, and there is a good chance that ITC with a good management and other thing they can have that return. And then if you think of the 30% return, it is perhaps a little chance hai, ho jana chahiye. Virat Kohli is batting, so it is possible. So you put more probability. But 35%, yes, there is a distance chance, so your probability is less. So this is how you spread the different type of returns with different type of probabilities. And now, when the possible returns are denoted by xi, say, for example, and related probabilities, so one is related by xi, here it is xi, and another is related by xy, then you get a probability 10 into 0.10, 20 into 0.20, 22.5. So these are the results, and if I sum it up, I get the expected value. That means what is more likely to be the return. Okay, so here we get 25.14% in this problem. Trust me, I have solved it. So also it is there in study material who are registered. It is the sum of products of possible returns that with respective probability. So I have taken all probability into considerations, and then I find that in all probability, everything taken into account, it is very likely that my return will be 25.14. But I am not certain. This is again a mathematical deduction or statistical deduction that our return will be around 5.14%. Now let us try to find out the risk or the uncertainty of this not happening. I told you in the previous slide, the uncertainty is not this happening. Uncertainty is not this happening. Okay, so let us move into this. Let us try to find out the risk. Now, the variability of returns from the now I'll go so slow on this. Give me time and read the lines. I'll explain it. Okay. Now, the variability of returns from expected value of outcome is quantitative description of risk. So that means if my expected return was 20, my expected return was my expected return was 25.14, but I thought I'll be getting only 10%. Sorry, I'll get only 10%. Then the variation is there. So this is a positive risk. I get more. But same way, if I was expecting 35%, I was expecting 35%. Sorry. I'm sorry, something is wrong. Just a minute. So now let me go to the next one. So here if we the variability of returns from the expected value of outcome is quantitative description of the risk. So I explained you when I am getting more return than what I could have thought, that's a positive, and in some cases that is a negative. So there is a statistical procedure used for the purpose, the calculation of standard deviation. Now, suppose the standard deviation in this particular problem is standard deviation is 0.066. Standard deviation is 0.066. Standard deviation is 0.066. Now, if the investor object is to maximum, if the investor object to the maximum risk, if the investor objective is to minimize the risk, the one with minimum standard deviation can be selected. There was some technical hitch in this presentation. I'm sorry for that. I apologize. So now, what I hope I am able to make it you, there is a standard deviation which is from the earlier value which we got, far away from that or far closer to that. If it is closer to that, that means my standard deviation is less. If it's this, like that. So I will try to, the variability of returns from the expected value of outcome is quantitative description of risk. So if statistically, if you find the standard deviation is 0.06, and in another security, another stock, in case of ITC, suppose in case of Larsen Toubro, I find the risk is less or standard deviation risk. So that means if they both are giving the same return, I will choose Larsen and Toubro. Is it clear? So the investor's objective is to minimize risk, and the one with the standard deviation can be selected. Okay? because of the technical problem, there are some hitch. I'll go to the next slide. Now let us understand the types of risk. Now the types of risk, I hope this slide is clear to you, or if you want to explain, I'll come later on, I'll explain it again. Having said that, let me proceed for the next slide. So far we have talked about risk. Now there are what type of risk? What type of risk? There is a systematic risk which refers to overall risk. There is a systematic risk which is overall risk. Just a minute. There is some technical issues. We're correcting it. Systematic risk. Systematic risk is also known or as refers to the overall risk that is inherent in the entire market or an entire asset class, rather than being specific to a particular company or industry. You know the difference between a company and industry? Steel is an industry. Tata Steel is a particular company in that industry. Similarly, telecom is a sector or industry. Airtel or Voda is a particular company there. So there are certain risks which is inherent to the entire market or an entire asset class. I'll give you two examples. Suppose there is an overall increase in the budgetary support to the telecom sector. Now that will affect the industry, telecom industry. Or suppose government increases or decreases the custom duty of Chinese iron coming to India, then the whole steel industry is going to have some problem because Chinese steel will be cheaper. So these are the systematic risk. Or sometimes government says increases import duty of all products. Then maybe all the industries which import and manufacture something will face problem. Alternately, government can increase the interest rate. If the interest rate is increased, it affects all the industries because their input cost will go up and the cost of money will go up. So everybody will be affected in a different way. Somebody will be affected more, somebody will be affected less. Those who have taken too much of loan, they will be badly affected. Those who have less loan in the market, they will be less affected. So this is what is all systematic risk. Investor can manage systematic risk and return risk through asset allocation and diversification little bit. So you know that this particular sector is more vulnerable to government policies, whereas the other sector in which I am investing is not that vulnerable to the government policies. Yesterday or earlier I have told you FMCG, that is usually what the products we regularly buy, from the soap to the detergent to the thing, these are not very much affected by the government policies. But when I invest in steel, suppose Tata Steel, or I invest in some export-oriented companies, then because of the government policy, the risk can vary, but the return will also vary. So if I can make an allocation between both or more diversify my stocks, I can reduce that systematic risk to some way. But this cannot be completely eliminate systematic risk. So I cannot completely eliminate the systematic risk. It's clear? I cannot completely eliminate systematic risk. This point you have to keep it in mind. So, shall we move to the next point? Yes, we will. There are different types of, so इतना systematic risk हम बोल रहे हैं सर बताओ तो, tell me what are the systematic risks, try to take care of it. First and foremost is the interest rate risk. Now you all know that if there is an interest rate risk and you have invested in Government of India or whatever debentures, and debenture is giving an interest of 6% or 7% or 9%, and now the interest rate has gone up. So what will happen? The debenture you are holding, that is giving less return. So given a choice, you want to sell that investment and you want to buy a new debenture which will be giving higher interest. I repeat it. You are having an interest bearing that is 7% or 8% debenture. But then you find that interest rate has gone up, Reserve Bank has increased the interest rate, so somebody is coming up in the market with 10% interest rate. So you will always like to get more interest rate. So you like to sell that 7% interest rate instrument or debenture and buy 10%. So what will happen is that 7% interest may, like you, there will be many more sellers, there will be more sell on that, and if there is more sell and no buyer, the price of that bond will go down. So if you are holding that bond, you lose capital also perhaps. That's one type of interest rate risk. What is the second type of interest rate risk? Suppose a company, Adani Port or Adani Power, has borrowed money at 9% or 7%. Now the interest rate has been increased to 10%. Earlier, Adani was having a margin of 5% or 6%. Adani was having a margin of 10% or 6%. But now, interest rate has been, other things remaining same, interest rate has been increased, 6% margin tha. Interest rate has been raised from 7% to 9%. So 2%. So its income will come down by 2%. So that's the moment their income come down, the stock price will come down. Or if they want to pass on this interest rate, their sales may come down. So this will not happen to Adani only. This will happen to all the companies who have borrowed money. And most of the companies, they borrow money for growth. They borrow money to supplement their capital. Because borrowing is not bad up to a point. So this interest rate risk affects two ways. First, the manufacturers or service sector who are borrowing to fund their operations. Their net margin comes down. And what is the second factor? Those who are in investment business or those who are invested in the bonds or debentures, etc. Since interest rate has gone up and he has a instrument where the interest rate is 6% or 7%. So you'd like to leave that and go to the 10% interest. So like him, there might be many sellers and the price, which is face value generally 100, will go down. If there is more sellers in the market and less demand for that bond, the price will go up. Demand and sales ka function hai. So you also lose. So the financing or investment people, they also lose. When the interest rate risk, I'm talking about the one side, and if it goes up, then the manufacturing and service sector also suffers. So this is the one side or the bad side or the negative side. On the reverse side, as it is happening now, interest rates are being reduced. Now when I reduce the interest rate, Bajaj Finance, which is a large just giving loan to your domestic consumer durables. In fact, most of the shops ka bahar mein you will see Bajaj Finserv and other things, etc., etc. So their cost of fund, because they are borrowing, their cost of fund will go down. So they can pass on something to you, and since you are getting at less interest, you will buy more cars, more domestic appliances. Clear? So interest rate risk, this is the way interest rate risk affects your ultimate return, because if you sell more, you will make more profit, but an increased interest rate will eat up that more profit, and you will end up less profit after tax, and naturally your dividend or appreciation of your capital will be coming down. But if interest rate falls and your sales goes up, then overall your profit will go up after tax, and then naturally your share price will go up. If you're an investor, if the interest rate goes down, you are in a dicey situation, because if you have invested in bonds and other thing, then your that portion of the return will come down. But if you have some other equity and other thing, they will try to do well because their operating cost has come down, so their margin has gone up, their profit will go up. So if you have balance between equity and debt intelligently, then to some extent you can eliminate the effect of interest rate risk. So what I said in the beginning, here, I am supporting that with this explanation. Now let's come to the market risk. The market risk is when, suppose I am manufacturing a particular product, pan parag or gutka, and suddenly there is a ban or there is a heavy duty by the government of India. So naturally there will be price has to go up, and many people may not be interested to consume gutka at that price. So I have a market risk there. My market will shrink. Only people who can afford, they will buy, but the mass market will slowly reduce their number of buying. Suppose they were having 4 sachets, they will be having 2 sachets, or like that. So this is my market risk. At the same time, there is a negative side. On the positive side, like it recently happened, GST was reduced. So what has happened? Almost many products which we buy regularly, or even if you don't buy regularly, like cars and two-wheelers, the prices has come down. So during the puja and the post-rain, the puja in the September, October, we found the bumper sale of two-wheelers and four-wheelers. So market risk can go up, can go in your favor, depending on the industry you are in and how it is going to be affected. And it can go down depending on the industry you are in or other things. So here, as I told in the first slide, the analysis, understanding of the broad economic scenario, and that bit of estimation about the future will help you to pick stocks which may be affected in the market risk, and some may be affected in the positive way. So if you put both in a basket, if the market risk happen, your overall expectations may come down, but it will not be negative. It's less likely, but sometimes it may, because as you said in this, they cannot be completely eliminated systematic risk, because this comes from a force, government force, which is very difficult to assess the full impact, right? Similarly, suppose the petrol prices go up, the freight cost will go up. So all the material cost will go up at destination point. But some of the producers can absorb the shock partly and will pass on some. So you have to choose which manufacturer or which stock, which company has the capacity to absorb these fluctuations. Same thing about interest rate. If I have a lot of my money, I have borrowed less, then I will not be affected. But if I have borrowed too much, like Pantaloon, I go bottom up. I have to sell it off to Reliance Industries. It was a mixture of both interest rate because they have borrowed heavily, market risk because COVID and other time there was no market, nobody was going to the market, so all those malls were empty. And what you can do, you have to pay salary, you have to pay the rent and other things. Salary you can get them out, but rent and electricity and other things you have to pay to some extent. So this is what are the things. So if you have invested in Pantaloon or Big Bazaar or Future Retail, and you have to balance it with some pharma company and other thing, maybe your overall effect would have been minimized. I hope we are in the same page so far market risk. Now comes the third one, that is inflation risk. So what happens in inflation? You remember in the very beginning we talked about nominal rate and real rate. So if interest rate in the market is 16%, or for that matter, suppose your earning is 50,000, but stock price, the goods price has gone by 15% or 10%, that's the inflation. So your purchase power has now come down. The domestic consumable items, the 20% or 30%, which goes into your grocery, school fees, or groceries, milk, bread, etc., has gone up by 15%. Okay, your school fees has gone up, your medical expenses has gone up, so there is inflations. So your net savings, what you can put it into the securities market, has come down. So what will happen? People will not buy more. If people don't buy more, the sales is not high. If sales is not high, my profit after tax is not high. So ultimately, my share price will fall. And there is a capital loss. Or I may not be able to give dividend. So inflation is a very beastly element. It's a very bad animal which eats up your purchasing power. It's like termite, it's like diabetic. अंदर से आपको खोखला कर देता है. So you think you are earning a lot, 1 lakh, but the price of things. Suppose I'm giving you an example. If you are earning 1 lakh in Mumbai, you are earning 1 lakh in some small town in near Kolkata or some other place. So your net available spendable income will be much more in that village or that town than in Mumbai, because Mumbai your house rent will be high. Your general purchase price will be high, your school fee will be high. So what is left to you is less, which you can invest. So you have to earn more or whatever it is, which is difficult. So I have explained, and it's affecting everybody who are in Mumbai or who are in other places. So these three risks, which are systematic risks, these three affect all, but to different degrees. And if you are an investor, which we are studying now, if you pick up stocks through your analysis and your analytical power and knowledge, that if these things happen, which stock A may be affected, but not that much, B can have a good effect, C can have a not so good effect, then A, B, C in total will give you a decent return. May not be as per your expectations, but it will not generally nullify your positive return, but it may happen if the interest rate, market, inflation happens simultaneously. Then it's very difficult to protect your investment at that time and get a return. So you have to book loss, or you have to remain with the investment for the time being, which investors do, speculators do not do, and then the bad time comes over and the good times come, and then you start again making money. So this is all about systematic risk. I hope you have made it clear. We have made it clear, systematic risk. And now I am going to the next slide, which is unsystematic risk. Now, unsystematic risk, as the name says, is a specific risk or diversifiable risk, refers to the risk that is specific to a particular company, industry, or asset class. Now, you need an explanation. So suppose I reduce the import duty on steel. So it will affect the industry, steel industry. But maybe Tata Steel, their they don't have loan and their interest cost and cost of production is very low, so they can reduce the price and they will not be affected that much. But Jindal Steel, which is a good borrowing and is a new plant, so their cost is a little higher side, so they will be affected a little more. But at the same time, if I buy some stocks which has nothing to do with the interest rate or custom duty on steel and other thing, which is produced here, consumed here, Dabur or Marico, or some ITC products, ITC, or Hindustan Lever. I buy some pharma. So then what is happening? I am diversifying. So loss in Tata Steel or Jindal Steel is not eating up the return which I am getting for Hindustan Lever and ITC and other places, or maybe Airtel, or maybe banks, etc. So what is happening? Overall, I am managing this risk by diversifying. I repeat it again. Uncertain risk is also specific risk or diversifiable risk. They say it is diversifiable risk. So it's a particular company or industry and asset. So if you don't put all your eggs in one basket and you diversify intelligently, if I have something amount of steel, I will some amount of FMCG, I will something about pharma, I will something about Infosys TCS, they are export oriented company, they are making money. I'll have something NBFC because they give loan, and housing finance companies because they are very steady, or I can have some power companies because people will consume power and they will give me a decent return, come what may be. And so the total portfolio of yours is not affected by one risk. You have reduced, if not eliminated, that actually you cannot eliminate. 98% you can move out almost, but 2% risk remains in the system. Unsystematic risk also. So, but to a great extent, you can eliminate this unsystematic risk. Let's go to the next one. Example of unsystematic risk is include company management issues, supply chain disruption, labor strike, product recalls, legal liabilities, like that. Like suppose Vedant, you come to know there is some issues in problems and other things, so you may get out. Suppose you have shares of Indigo and you know they are in trouble, and you think that okay, for the time being, let me get out of the Indigo. So I'll get out of the Indigo. I'll look for some other airlines, Tata Airlines, or something listed airlines, etc. Or some company there is a labor strike and you don't foresee any quick resolution of the labor strike. So what happens is that in your basket, you can remove those eggs and put new companies which are more stable in the given change scenario, right? So this is how you can use the unsymmetry risk by shuffling your stocks and diversify your different investments. You can have something in your fixed income securities, you can have something on your pharma, something into your IT, something in the financial sector, something in the real sector in the sense Titan, gold, and other thing, etc. Like that. I mean, it depends on all your advisor, and if you're doing your own analysis on that, what are the things I'll put in your basket, and you have to keep and watch. You just can't put it there and forget it. You have to put it in the basket and keep and watch. And if you see that something industry may there is a problem coming, your future you can estimate or guesstimate, and then you may or may not hold the stock. If you think it's temporary, you can hold the stock. If you think there's uncertainty is and for unknown time, then you can get out of those stocks. Like as of now, we don't see when this US problem will solve. So the export-oriented companies whose bulk export is in USA, we may sell those stocks, and that money we can invest in some of the industries or companies which is manufacturing here and selling in India and making a decent profit, right? So this is a continuous watch. The third para is saying that by investing in a range of assets across different companies or industries, investor can reduce, if not eliminate, the risk. We have seen, this is not a scientific evidence of it, but if you diversify between 15, 20, the risk slowly starts coming down, and then iota of risk remains, even if you go to 30 stocks or 40 stocks. So 20, 24 stocks, and you can see in the mutual fund list, they also have similar type of stock, diversified stock from different industries, different capacities, some large cap, some mid cap, some small cap, and they diversify this risk, and they want to reduce the unsystematic risk, because systematic risk you cannot. Now let's come to the financial risk. What are the three risks? We have also learned earlier: interest rate risk, financial risk, business risk, management risk. So I will be quickly going through this three risks. Let us say what is financial risk. Suppose I have borrowed a lot. I'll go back to the example of future retail. That means my interest, whatever I earn, it goes into servicing the interest. So what will happen is that I will be having less money to the shareholders, so that my share price will not go up. And if the interest rate goes up, then I may not be able to service that. So that is a financial risk my company follows. So you don't buy in that case a company which is heavily borrowed. You have always choice of buying a company which has less debt in its books. So annual reports are available with you. So that is how you can choose reduce the company with the more financial risk, or some company which are regularly unable to collect money. This is some sort of businesses also, and they are unable to manage their liquidity. Liquidity means your at any given time you should have sufficient money to meet your immediate liabilities, that is your contingent liabilities, your sundry creditors and other things. But my current assets are very high, so I am facing, because I am not getting money from my sundry debtors, and sundry creditors are pressing me, so I am always in a financial squeeze. So I would like to prefer the company which has a comfortableness there, so that they can freely do the business. They can collect the money from the debtors very fast, and they also pay the creditor in time. Rather try to go for those type of stocks. Like I can't give an example. I mean, that is the protocol. So you can choose by your analysis which company has a better short-term financial management, that is current assets and current liability may, they have sufficient money to meet the current liabilities. So one is long-term liabilities where the interest pay is high, and it can create a solvency problem, and then default. And the other side, there is a short-term where you can not pay and you earn a bad name from the industry. Business risk is Suppose you make some product like the telecom sector. What happened? Suddenly, some big players came in, like Reliance and other things. The game changed. Then many of the small players who are into the market, they had to leave because they didn't have the product, they didn't have the business model proper, they didn't have the capacity to go, etc. Same thing happens about the telecom mobile phone manufacturers. Okay, now we are seeing in the paint industry that earlier Asian Paints, Berger Paints, Jensen Paints were enjoying some sort of monopoly. But now there is Indigo Paints, of course, it's a South-based mainly. But you have Builder Opus, you have JSW Paints, and maybe one or two paints are coming. So there will be competition, and if you can, your business is risk is there. If the raw material is shortage and somebody can buy more, they will have the advantage. Or if you are in your business, the raw material particularly is not available from the market. As you know, the semiconductor, those who are manufacturing the car and other things, may you need the semiconductor, and there is a supply bottleneck, so you can have a business risk there. Third and the last is the management risk. If the management is not very well governed and they cannot anticipate the strategic issues earlier, and they are always taking short term measures, then you have a problem. Management should have a vision, they should have a long term vision, and they should be prudent enough to take loan which is required, which can be serviced, a manpower which is productive, and diversifications which fits in into with their overall strategic goal, not at random like video call. There was a time when videocon TV was everywhere, then there was a random diversification, and today we never hear of videocon anywhere. Samsung and LG has really captured the market. So that is because of management failure totally. So these are the three risks which is company specific, which could have been avoided, and so unsystematic risks in the process could have been reduced. But as I told you, systematic risk is difficult to avoid fully. So you have to be focused, you have to manage it intelligently so that your overall risk in the company, total risk in the company, sum of systematic and unsystematic risk in the company is to the minimum. And if you risk to the minimum, then your return will be always better. And many companies will try to buy your company shares because the risk is less and the return is good. So you tell me, given a choice, same risk or same return, and one company has less risk, one company has more risk. A has more risk, B has less risk. You'll be buying B because B's risk is less. So that is what is the story of risk and return which we have covered. I'm sorry for the technical glitch in between. In your study material, you will get the problem of standard deviation, how it can be, and that concept is very important to understand the risk. Thank you for your patience and listening and going through all the things today. Our next session is investment theories, with which we'll come back tomorrow. Thank you once again. Good day.